Right now, our single best chart. We're going to do that with Gary Shilling here. And the single best chart is on oil, and it's a reaffirmation of what we saw yesterday. What a print on $39 a barrel oil. And when the chart comes up, that's where Shilling is. He's way down there. He's below Ed Morse. He's below Jeff Curry at Goldman Sachs. What is the distinction, Gary, of getting from a Morris-like 35 for a little brief time down to the permanence you see at a $20 level?
Well, there's nothing permanent about $20, but that's the marginal cost of producing oil in the Permian Basin in Texas and in the Persian Gulf. And when you're in a price war, and that's what this is, it's the marginal cost that matters. It isn't the full cycle cost of drilling a well with all the pipes and infrastructure. It isn't the cost to meet budgets for Saudi Arabia or Venezuela or anybody else. It's the marginal cost. And the Saudis are basically saying, this is what we're going to do. It's a game of chicken. We're not going to back out as we have in the past and let somebody else come in and grab our share, whether it's other OPEC countries, whether it's Russia, whether it's American frackers. They're saying we're going to the mat. OPEC, when they had their meeting November 27th, their quota was 30 million barrels a day. Now it's 31.6. They've taken off the limits. They're saying, hey, guys, we're going to the mat.
So is there any more of an oil dividend to be had from this extra drop? I mean, we haven't seen all that much go to the consumer.
Well, I'm sorry. Say that again.
If it does indeed reach the price that you see it at, will the consumer benefit immensely?
Well, the interesting thing about that is that about 85% of the windfall in gasoline price declines has been saved. People have not gone out and spent it. Now, a lot of people thought that that was going to do that and was going to spur consumer spending, but in tough times, people normally increase their saving rate. They do it in recessions, and they've done it this time. So you're not really seeing that windfall in terms of spending. It's increasing saving, and consumers obviously are way undersaved. Their assets are much lower than they need, a lot of people for retirement and so on. But it's not doing much for the economy right now. And, of course, the real question is, you know, if you get to 10 to 20 bucks a barrel, it's not going to stay there long. Somebody major is going to be forced to the mat, back out, and then eventually the price goes up to where the average cost is going to be covered by the price. But you can do a lot of damage in the meanwhile. And you've got the major oil companies right now, and what are they doing? They're basically borrowing to pay dividends. They really think that that's so important.
Gary Shilling, what a treat to speak to you from London. When we look at the price of oil, how can we be sure that this is an oversupply issue and that it is not something a lot more sinister, which is a demand issue? The fact that there is a concern that actually we're looking at the possibility of a recessionary growth.
Well, it's both supply and demand. I mean, if you have a situation right now where you've got about 2 million barrels a day of supply over demand, obviously that reflects not only the increased production of a lot of areas, and of course American frackers are getting a lot more oil in the ground than many people thought. They're getting much more efficient, but also demand has weakened. When you look at the slowdown in China, the continued slow growth in North America and Europe, and the whole global world. You look at the IMF, look at the World Bank. They're constantly cranking down their forecast for overall economic growth. Well, that obviously is very important in terms of oil demand. So you really have pressures on both the supply and demand side.
Yeah, but it's extremely difficult if you're a central bank to look at this and actually decide what your next course of action is. Does the low oil price mean more QE from the ECB?
Well, we're in a period, in my view, of deflation, and commodities are leading the way. And oil is obviously an important commodity, but it's not the only it's the only commodity. You look at the agriculture commodities, you look at copper, you look at the other non-ferrous metals. It's a pretty broad-based deal. Now, central banks, at least the Fed, they do have the target of price stability. All the major central banks have a target of 2% inflation. They don't like inflation, but they hate deflation. They look at Japan over the last 2 decades, and what happens? Prices decline, people get used to it. They wait for even further prices declines before they buy, and that means slow economy. And Japan has had about 1% average real GDP growth for 20 years. And that's the poster boy for central banks.
Very quickly,
they're really scared on this.
Are we becoming like Japan? That's the arch fear, isn't it? We're not Japan. We're not an island nation with limited demographics.
No, we really aren't. You look at Japan, they have the longest lifespans of G7. They have no legal immigration. They have a high living standard, but they're satisfied with it. It's a uniform population. I think it's very different.
Gary Shilling with